That's where Bitcoin traded at 4:32 p.m. Eastern Time yesterday, a surge of 14% in a single session. Headlines are calling it a breakout. Pundits are screaming about ETF inflows, a new bull cycle, the halving narrative playing out perfectly. The message from every major crypto influencer is the same. The path to $100,000 is clear. The institutions are here. This time, the rally is real. They are wrong. This move had nothing to do with spot demand, or ETFs, or a sudden collective belief in digital gold. What you witnessed was not the beginning of a new bull market. It was the final desperate unwind of a 12-hour, $0.3 trillion derivatives experiment that reached its logical, terrifying end. While you were watching the price on Coinbase, the real action was happening in the currency markets of Tokyo, the bond desks of Zurich, and the shadow banking corridors of Hong Kong. The trigger wasn't a whale buying. It was a central bank breaking a promise it made 15 years ago. And the dominoes it set in motion have only just begun to fall. This isn't a rally. It's a liquidation event wearing a party hat. And the forced selling that will crash this market and every correlated asset on the planet is not a question of if, but of when. The clock started ticking 96 hours ago. You just haven't heard the tick yet. Let me show you why. For the past decade, we have lived inside a singular, all-encompassing financial bet. It wasn't a bet on tech, or on AI, or on crypto. It was a bet on permanent stability. It was a bet that the world's major central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, would forever maintain a specific unnatural order. That US interest rates would always be higher than Japanese rates. That the dollar would always be strong. That volatility could be engineered away. This bet has a name, the global dollar funding carry trade. It is the mother of all leverage. And yesterday, it began to die. Its death throes are what you mistook for a Bitcoin rally. To understand why, you need to see the machine. The machine runs on one simple, borrowed premise: cheap yen. For over a decade, the Bank of Japan has enforced a policy of negative interest rates and yield curve control. This meant a hedge fund in New York, a family office in Zurich, or a bank in London could borrow Japanese yen for virtually nothing, 0.1% or less. They would then instantly sell those borrowed yen for US dollars. With those dollars, they would buy anything with a higher yield: US Treasury bonds, tech stocks, corporate debt, and crucially, speculative crypto assets. The profit was the spread. Borrow at 0%, earn 5% on a treasury, pocket the difference. It was considered a risk-free arbitrage. This trade is not small. At its peak, estimates placed the size of this yen-funded carry trade north of 1.5 trillion, but that's just the direct borrowing. The real leverage comes from what that initial trade enabled. Because this free money was so reliable, it became the foundation for a second, third, and fourth layer of bets. A fund would put on the yen carry trade, use the US treasuries it bought as collateral to borrow more dollars, and then lever that money into S&P 500 futures. They'd then use the paper profits from those futures as collateral to get a loan to buy Bitcoin ETFs or private equity stakes. The entire global financial system has been playing a game of Jenga with borrowed yen at the bottom. Every major asset class, stocks, bonds, crypto, real estate, has been artificially propped up by this endless, circular flow of cheap Japanese money. The price on your Bitcoin screen wasn't set by you and me, it was set by the cost of borrowing yen. This was the silent god of the bull market, and we just killed it. 4 days ago, the Bank of Japan, facing a currency crisis and domestic inflation it could no longer ignore, did the unthinkable. It didn't just hint at a tiny rate hike. It abandoned yield curve control entirely and signaled a full, accelerated normalization of policy. The message was clear. The era of free yen is over. The cost of borrowing yen didn't tick up. It spiked. Instantly, the foundational block of that global Jenga tower was yanked away. This is where the narrative fails you. The headlines say Bitcoin rises on dollar weakness. They have it backwards. The initial move was a frantic, panicked unwind of the first layer of the trade. Those massive funds, facing a sudden margin call on their yen borrowing, had to repay their loans. To do that, they had to sell their US dollar assets to buy back yen. This created a sudden massive wave of dollar selling and yen buying. The dollar index dipped. This dip, this momentary weakness in the dollar, was misinterpreted by every algorithm and momentum trader as risk on. They saw a falling dollar and bought the textbook inflation hedge, Bitcoin. But they were buying into a fire sale. The initial Bitcoin spike was a reflexive, algorithmic misinterpretation of a lethal signal. Now, here is the critical breakdown, the separation of paper from reality that will define the coming collapse. You saw a green candle. What was happening beneath was a controlled demolition. The entities being forced to unwind were not selling their Bitcoin first. They were selling their most liquid assets first to meet immediate margin, US Treasury bonds. That's why we saw bizarre, disjointed price action. Bonds selling off, yields rising, while Bitcoin ripped higher. It made no sense under the old narrative. Under the new reality, it was a perfect symptom. The liquidity cascade had begun at the core. The bleeding was inward from the periphery. But the periphery, the hyper-speculative, leveraged crypto bets, is next. They are the furthest out on the risk curve, the most dependent on that cheap funding. When the wave of selling reaches them, there will be no liquidity to absorb it. None. This pattern is not new. It is the oldest story in finance, the unwinding of a leveraged carry trade. We saw a smaller version in 2019 during the repo crisis. We saw it in 2008 when the euro-funded carry trade into US subprime collapsed. We saw it in the 1997 Asian financial crisis. The anatomy is always identical. Stage 1, the false dawn. A tightening of funding liquidity causes an initial counterintuitive spike in the riskiest assets as players scramble to adjust hedges and algorithms misread currency flows. This lasts 70 to 96 hours. Stage 2, the liquidity hunt. The selling of core, liquid assets, treasuries, blue chip stocks, fails to cover the margin call because the value of those assets is also falling in the panic. Forced selling intensifies. Liquidity evaporates in the bond market, causing violent yield swings. Stage 3, the periphery collapse. With core assets depleted and funding now impossible, the leveraged holders of illiquid, speculative assets, private credit, venture capital, crypto, have no choice. They must sell into a market with no bids. This is when the 20% down days happen. This is when exchanges halt withdrawals. This is when the narrative fractures from buy the dip to what is happening? Stage 4, the regulatory halt. Circuit breakers trip. Governments and central banks issue statements. A major crypto lender or hedge fund fails. The system seizes. We are currently in the final hours of stage 1. The data is not hidden. It is screaming. Look at the Tether Treasury wallet movements. In the last 48 hours, over $4 billion in new USDT has been minted. This is not organic demand. This is a desperate attempt by crypto exchanges and large OTC desks to provide the illusion of dollar liquidity in anticipation of the coming withdrawal tsunami. They are creating digital tokens out of thin air to meet the promises of convertibility they may not be able to keep. Look at the futures basis. The premium for Bitcoin futures contracts has gone negative, a condition called backwardation. This is a classic sign of extreme stress in the derivatives market, where the smart money is willing to pay a premium to own the spot asset right now because they fear the futures market itself may break. Look at the balance sheets of the publicly traded crypto miners. They have been selling their Bitcoin holdings aggressively for months, not holding, because they are the canaries in the coal mine. They know their operational survival depends on fiat liquidity, not a moonshot narrative. They are converting digital hope into real-world dollars before the window slams shut. The psychological warfare is already underway. Who benefits from you believing this is a rally? The entities with the largest, most illiquid bags to unload. The venture capital firms sitting on billions in locked up, worthless token allocations from the last cycle. The crypto lenders who need a final inflow of retail deposits to cover their legacy bad loans. The influencers whose entire revenue model depends on affiliate fees from exchange signups and perpetual optimism. Their narrative is a liquidity lifeline. Your belief, your buy order, is the oxygen keeping them alive long enough for them to exit. They are not your leaders. They are your exit's obstacle. They need you to hold the bag while they convert your stablecoins into actual dollars. Every tweet saying, "This is just the start," is a sell order in disguise. Let's destroy the comforting counter-arguments you're hearing right now. First, the Bitcoin ETFs have changed everything. They provide a permanent institutional bid. False. The ETFs are a wrapper, not a source of capital. They are a pass-through vehicle. The $10 billion they've absorbed, a significant portion of it was already in crypto, just moving from GBTC to a cheaper ETF. It was recycled capital, not new. More importantly, in a true dollar liquidity crisis, these ETFs face massive simultaneous redemption requests. The authorized participants must then sell Bitcoin on the open market to raise cash to pay out. The ETF becomes an accelerator on the way down, not a shock absorber. Second, the Fed will pivot and cut rates, providing new liquidity. They are trapped. Cutting rates now in the face of a currency-driven inflation shock from a collapsing yen carry trade would vaporize the US dollar's credibility and ignite hyperinflation. They will choose to defend the dollar. They will let assets crash. The Fed put expires when the stability of the global currency system is at stake. 2024 is that moment. Third, this is just a healthy correction. The halving is in 2 months, and that's historically bullish. The halving is a predictable, scheduled reduction in a minor flow-based subsidy. It is utterly irrelevant against a $1.5 trillion tidal wave of global macro leverage reversing. It's like claiming a campfire will keep you warm in the middle of a hurricane. History shows that in environments of tightening global dollar liquidity, all risk assets fall together. Correlation goes to 1. Bitcoin will not be a safe haven. It will be one of the worst performers because its liquidity is the shallowest. So what do you do when the machine is breaking? The goal is not to predict the exact top or bottom. The goal is to not be a forced seller, to be a patient observer with dry powder when the real sellers, the leveraged institutions, are finally exhausted. This requires a complete mental shift. Action 1. Treat your stablecoins like a bank account that may freeze. Gradually, methodically, convert a meaningful portion to actual fiat dollars held in a regulated traditional bank account. Not because the bank is safer in the long term, but because in the short-term liquidity seizure, being in the legacy system's settlement, cash gives you optionality. It makes you a buyer when others cannot. Action 2. Step away from leverage. If you are in futures, perps, or money markets, exit. The volatility that is coming will trigger stop losses and liquidations at prices that seem impossible. The exchange may not even be able to process the liquidation orderly. Your 10x long will be wiped out at a 40% downside wick in seconds. Action 3. Shift your focus from price to plumbing. Stop looking at the Bitcoin USD chart. Start monitoring the Bitcoin dominance chart BTC-D, the tether premiums in Asian markets, and the 3-month Treasury bill yield. When the true panic hits, Bitcoin dominance will soar as altcoin liquidity vanishes. The tether premium will turn massively negative as everyone tries to flee to dollars. The T-bill yield will spike as everyone rushes to the only truly safe liquid asset left. These are your signals, not some influencer's bullish tweet. Action 4. Prepare your mind, not just your portfolio. The narrative over the next few weeks will be chaotic, contradictory, and designed to provoke emotional action. You will be told you are missing the rally of a lifetime. You will then be told the entire system is fraud and to sell everything. Both are traps. Your greatest asset is patience. Your strategy is to preserve capital. The opportunity to accumulate real wealth in this sector will come after the leverage has been purged from the system, when headlines are despairing, and the word crypto is met with laughter and scorn. That is when the machine is clean. We are not there. We are entering the storm that cleans it. This is not doom-mongering, it is pattern recognition. For 15 years, financial gravity was suspended by the artificial magnet of free Japanese money. That magnet has been switched off. Gravity is returning. What falls fastest and hardest are the objects that were lifted the highest on the thinnest thread of leverage. There is no conspiracy, just cause and effect. There is no they, just a series of rational actors all trying to get through the same narrow door at the same time. The price on your screen is a lagging indicator. It is showing you the last echo of a dying regime. The real price, the price of survival, of liquidity, of stability, is being set right now in the currency swap markets, and it is skyrocketing. The smart money isn't buying this Bitcoin rally. The smart money is using the liquidity it provides to get out. You now see the machine. You see its fuel, its gears, and the crack in its foundation. The noise will become deafening. The charts will become manic. Your job is to remember what you just learned. This is not a breakout.